EQUITYMATES.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Welcome to another episode of Equity Mates, a podcast that follows our journey of investing. Whether you're an absolute beginner or approaching Warren Buffett status, our aim is to help break down your investing journey from beginning to dividend. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Another Monday episode.
Yes.
Happy reporting season.
Thank you.
Yeah,
It's always going.
It's that wonderful time of the year that seems to never stop and always be around the corner.
Well, yeah, in the States particularly, every 3 months. I was thinking about this in preparation for the episode today, how much time would be spent by these companies doing reporting. And, you know, we're going to be talking about investor letters today and having to think about and write a meaningful letter every 3 months.
Yes, that would be tough for you. It takes you about 3 months to think.
It's true.
Yeah, I agree. I mean, have you read the book The Outsiders? Mm-hmm. And how for those who haven't read it, it's a story about like 8 CEOs who have just had incredible long-term track records. And one thing that a lot of them did, they just didn't care about investor relations, and they were like, "Buy my stock, don't buy my stock. That's not my focus. I'm just going to make a more valuable company."
Fair enough.
But yeah, you're right. For a lot of these bigger companies, the dog and pony show just keeps on rolling.
Yeah. So today we are going to be looking at 2 investor letters. Every quarter, investors, large and small, write to their clients, particularly over in the States is where we're going to be focusing today. And for us, they're a pretty valuable source of information. You often put them out in the thought starters on a Monday, and we're going to go through 2 today and pick out some of the stocks that they've specifically been talking about.
Yeah. Before we do, one note of housekeeping. We have a live show this week, this Thursday. Tickets for the in-person event have sold out, but we have tickets available for the online stream. Head to our any of our socials, really. There's a Facebook event that will take you to the Eventbrite page. Free tickets. It's free to sign up for the online stream, and there are prizes to be won. Stake are giving away $150 worth of stock in some of the biggest beverage companies in the world. They're giving away some merch. We're giving away some merch. We're giving away some books. So make sure you're on the live stream. Make sure you're participating. And
What's it about?
Oh, it's about the beverage industry.
What can we expect?
It's just us chatting, really.
Gee, that is not inspiring.
Nah, we've got some of the biggest experts in Australia, some from the industry, some investors in the industry, and we're going to be breaking down the beverage industry in Australia and globally and talk about how you can invest in it. So don't miss it.
Don't miss it. See you there. Okay, well, let's crack into it. Anything you want to kick off with, Ren?
Yeah, so before we talk about the 2 particular letters, just, I guess, a bit of context. So the investor letters come out in the same cadence as US reporting season. So every quarter, these letters come out. In terms of where you can find them, if you want to play along at home, there's a subreddit, security analysis, reddit.com/r/security analysis. They aggregate the majority of the letters. So if you're looking for a place where you can find these, you can read these, the 2 that we're going to talk about today, but just more generally, all of the letters that come out, you can head there and they aggregate them all. You can access them for free. One note about reporting season before we get into it. It feels like it's a real tale of two stories. That doesn't make sense. But I don't know if you've been watching the results, but so many big American companies are beating analyst expectations. Like, that's a great news story. They're doing incredibly well. But a lot of them are seeing their share prices fall, even though they're beating analyst expectations. Just shows how high market expectations are around these stocks.
Not surprising that you see weird price movements around reporting time versus expectations, but unusual that even though they're beating expectations, we're still seeing price fall. We're We speak about it a lot on the show that you can never base an investment around an analyst expectation.
Yes, yeah. And I guess that's the context in which we're talking about these letters. That the US, so they're both from the US, but the US economy is rebounding well. Australia's economy is rebounding well. But as a result of that, stock market expectations are incredibly high, and it's run incredibly hard since COVID.
Yeah.
And so these are the two contexts where these letters have come from.
Letter number 1, and we are going to be diving into some specific stocks. So there's an absolute doozy in this one. Is David Einhorn, his Q1 investor letter.
Yeah.
So who is David Einhorn?
David Einhorn, perhaps most famous for being taunted online by Elon Musk.
Yes, the shorts.
Yeah, and Elon actually sent him a pair of shorts.
Those red ones that he had on sale a while ago.
Yeah. So there is context there. Elon's not just sending him clothing.
No, he was, but they were shorts targeting short sellers.
Yeah.
Of Tesla stock maybe 3 years ago or thereabouts.
Yeah. Einhorn was probably the most outspoken Tesla short, claiming fraud, especially around the Solar City acquisition, just claiming so much stuff. I mean, I don't know if he was right about a lot of this stuff, but the market has definitely caused him to lose a lot of money. On that.
There's no doubt this guy's pretty cynical, I think, all around. You read this latest letter and he's having a whinge again. But anyway, he's founder of Greenlight Capital, has $1.6 billion asset under management, started back in 1996 and had a decade of pretty incredible performance, averaging a return of 26% a year.
Not bad.
Not bad. You would definitely take that. More interesting, though, is that he had 12 billion assets under management. So, quite a fall from grace.
Yeah. It's actually been a pretty public fall from grace as well. It would be pretty tough to be him. He was riding high, and then he has seen over a decade now of underperformance against the market, and people like institutions and stuff have been pulling their money. So he had 12 billion assets under management. He now has 1.6 billion assets under management.
Tough.
Tough.
He'd just see his fees going down.
Yeah,
and
I mean,
down
look,
and down.
I don't have a lot of sympathy for him. He is a billionaire, so he never needs to make another dollar in his life. But yeah, that would be tough, and it shows just how difficult sustaining and investing over a long period of time is.
Yeah,
it's very rare that you see Warren Buffett get 20% plus return for 40 plus years. Like that's the exception, not the rule.
All right, Ren. So let's pick up from commentary around the macro environment from his letter, and then we can dig into some of the stocks that he's spoken about. He has massively outperformed. Let's start again. So since 2008, growth has massively outperformed value.
Yes.
However, in the past quarter, we've seen a reverse of that with value outperforming growth.
That's it. Largely driven by expectations of inflation.
Yeah.
And, we all heard in the quarter around bond yields rising, inflation expectations being back. We're not particularly seeing it in CPI, like the Consumer Price Index, measure of inflation, but he talks about a number of, I guess, supply bottlenecks, the amount of money being pumped into the economy. There's a lot of leading indicators of inflation. So it's probably going to happen.
Yeah. You would think so. And there was no doubt that the EQUITYMATES community felt the reversal of growth v value when some of their tech positions were hit in the last 3 months. And that's obviously coming through.
Yeah. I thought when the Suez ship got stuck, I was thinking if that had got stuck there for not, 4 days but like 4 weeks, then what would have happened to like inflation with a literal supply bottleneck. Forget semiconductors bottleneck. That was
That was the black swan event that may have triggered inflation.
But yeah, I think a lot of the letters are focusing on this growth v value discussion, and partly because it's the industry talking to the industry, and this is something that the industry loves to talk about. And also we should say, so Einhorn I think was flat for the quarter. Again, not what you want to see as one of his investors, but
flat for the quarter, and the market was up 6.2%.
Yeah. So not great.
Another tough quarter.
And I think some of these letters you can see a little bit of self-justification in
Definitely.
underperforming.
Performing.
I get in my own head about that now. And they're saying value's coming back. It's almost here. We're about to really hit our stride. And so I think there's a little bit of that from David Einhorn. In saying that, though, he does list 6 of his best stocks for the quarter.
Yep.
Tell me if you've heard any of these names. Bright House Financial.
No.
Danimer Scientific.
No.
Concentrix.
Nope.
Residio Technologies.
No.
Change Healthcare.
No.
AirCap Holdings.
No.
Yeah. So, and this is why I love investor letters, and this is why I think they're such an underrated source of information, is there's 6 stocks that I hadn't heard of when I read it, and that you haven't heard of, but it gives you 6 stocks to go and research. All those stocks were up between 18% and 60% for the quarter, so they were...
and he's still flat.
Yeah.
Ouch.
He had I mean, they don't list everything, but he had one short position that he lost 40% on, and I think his short book in general didn't do too well.
I'm pretty sure I've seen Bright House advertised on like KO or something. Yeah, they're in a life insurance company. Anyway.
There you go. Yeah. And so, yeah, for me, it's like you have people doing the work for you, and you can see the companies that they've screened for, and then put them on your watch list, and then do the actual stock research. But it helps with the filtering process.
But caveat as well, if you're looking at Danimer Scientific here, that's up 61%. That is obviously in retrospect, in the fact that he has already bought the stock, done the work, probably months and months ago.
Great call.
Months and months ago, and he's maybe in a position that he's going to sell it in a couple of months. So do your own research when you see these sorts of things.
Yeah, and I mean, people have got in trouble for the past for doing exactly that and then selling into the buying. Like, I'm pretty sure that's how Rene Rivkin got done back in the day. He would pump a stock that he had already bought, and then he would sell it as people who were like reading his newsletter bought it. Now, don't quote me on that, but yeah.
Dodgy. Well, there was one. So the biggest theme that I got from his letter, Ren, was actually around his frustration with regulation in the market. And, the GameStop saga, he had a big whinge about how can, having a big whinge about Elon Musk and how regulators only give him a slap on the wrist for pushing up the share price of Tesla on Twitter, pumping GameStop on Twitter, having a big whinge about a number of things that he sees as big issues that are with the market in terms of fraudulent behavior and pumping and dumping stocks.
It's getting to pretty dire straits when free market capitalist billionaire investors, some of the people that hate regulation more than anyone else, are arguing that we need more regulation.
Yeah. That's what I was thinking when I was reading it. I'm just like, he's trying to throw as many eyes away from his performance as possible. Let's put it on.
I think I've chewed your ear about this offline. Like, I so wholeheartedly agree with him. Some of the stories coming out of the US about how underfunded their regulators are is just, it's disgusting. Like, I included an article in Thought Starters probably back end of last year, sometime last year, where the Department of Justice has so little money for enforcement left that sometimes they have to put out a memo saying the Department of Justice is targeting, white collar crime or, insider trading. but they just have to hope that that memo stops people doing anything because
Yeah.
they don't have the money to actually target it. Like, how can you get into this situation and expect markets to function efficiently and bad behavior not to start springing up? And I think that's one thing that we can be really proud of in Australia, but we really have to hold on to is a properly funded regulator that has teeth.
True. But let's get back to the stocks. There's one that we want to call out that was in his letter that is a classic example of, what he's talking about. Well, it's not a classic example, but it raises a lot of eyebrows, and that is Hometown International, the $100 million deli.
Yeah. This is his example of where the hell is the regulator? Where the hell is the cop on the beat? But it is a crazy story. I mean, do you want to give the overview?
The overview is that there is... A Hometown International is the holding company that owns one single deli in rural New Jersey.
Yeah, publicly listed.
Publicly listed on the stock market.
Or on over the counter, but yeah, publicly listed.
Yeah, one deli in rural New Jersey. Now, we jumped on TIKR, which is one of our favorite platforms to be using for this sort of information. By the way, if you would like to use it, it is in beta and you can get exclusive access by heading to TIKR.com/EQUITYMATES. They have had revenue ran over the last 5 or 6 years of $76,000, $50,000, $32,000, $22,000, and $14,000. And yes, that is 14,000, not 14 million.
Yes.
So incredibly small revenue. Its profit is, it hasn't generated any profit. It's had loss of 190,000, 104,000, 108,000, 149,000. Then out of nowhere last year, loss of 631,000. What would you expect its market cap to be?
Well, honestly, I wouldn't expect one rural deli to be listed. But a company averaging, its revenue, it has gone backwards every year from 76K 5 years ago to 14K. Obviously, COVID interrupted, but still, you'd maybe pay like 5 times revenue, if that.
5 times revenue, so you'd be looking at what?
You'd
about 75,000 or thereabouts.
honestly, a company that is going backwards and losing that much money
is worthless.
you just wouldn't buy.
Yeah. Well, Ren, you'd be surprised to know that it has a market cap of $100 million listed on the stock exchange.
So those numbers were from TIKR. I jumped on Simply Wall Street because you know how when we did the Veolia and Suez episode, they had the valuation check. Mm-hmm. I was like, I wonder what Simply Wall Street spits up for this valuation. It's just too.
It can't do it.
It can't do it. Like it was just like massive red crosses on everything in there. Just a sea of red, and it was like it is just significantly like out of the range. So, it's pretty funny that it's got 6 employees.
Yeah.
This deli.
So I guess what Einhorn's calling out here is how is this even possible?
Well, how is it possible?
Yeah. Well, pump and dump. What we were talking offline about potential for money laundering.
Well, now we should say that this is all wildly speculative,
Yes,
alleged, and we have no information about what it actually is.
No,
but,
we have no idea why it's...
While we're caveating it like that, yeah, it's like, could it be money laundering or something? But you would think if someone was money laundering, their revenue would be incredibly high because it's like they're bringing in all this cash business, recognizing it as revenue, and then cleaning it through the business. So the fact that it did 14 grand in revenue, like, that doesn't make a lot of sense.
600,000 in loss. But anyway, that's it's a pretty interesting letter. If you would like to find it, as Alex said, head to Reddit and the security analysis page, and there is a thread there that'll have it in there. Otherwise, you can... I'm sure you can just Google it.
You can just Google it,
Yeah.
and I mean, some of them are private. Some of these letters are only meant to go to their investors, but then people just publish them online. Others are public, and you can just get them from these funds' websites. But yeah, I just use Reddit.
All right, Ren, we are back with the second letter, and this time it is from Ensemble Fund. Not a billion.
Not a billion.
dollar fund.
Not a fund I'd heard of, to be honest. But I really liked their letter. I thought there was some really interesting stuff in here. Honestly, probably better than Einhorn's letter.
I agree.
But I guess when you're the smaller fund, you're fighting harder. You got to put that work in.
Yeah.
So this fund, Ensemble Fund, has $53 million assets under management. Since starting in November 2015, they've returned 17.5% annually, which beats the S&P 500 in a pretty good time for the S&P 500. So full credit to them.
Is that after fees?
Yeah, it should be.
It should be, yeah.
If a fund is publishing their returns before fees, that for me is a massive
Wouldn't
red
surprise
flag.
me. Wouldn't surprise me.
Yeah, I know, but it's like returns for who then?
Yeah, well, for them. All right, well, let's keep going. So for this one, we'll have a chat about what they've been talking about from a reopening point of view, and then we'll have a bit of a case study on one of their stocks a little later.
Yeah, a few good case studies in here. How's this for an opening line, though? If someone fell into a deep sleep on the 19th of February 2020 and woke up on the 31st of March 2021, they'd see the S&P 500 was up 19.72% since they last checked their portfolio.
Great.
How crazy is that?
Yeah.
It's not just that it recovered from the pandemic.
It's up 20%.
It's that it had a good year.
Yeah, amazing year considering where it came from.
20% a year is far better than average.
Yeah. Well, yeah, from the bottom, if you even more unbelievable. Yeah. It's crazy. All right, so they start by discussing that the world is reopening, and I didn't know this, but Goldman Sachs actually have a reopen basket.
Yeah, this is cool.
Yeah, which is 35 US listed stocks that they being Goldman, expect to benefit most from reopening. That basket was up 22%.
So it's like an index that tracks sentiment around reopening.
Yeah. Well, and that led me down a path. This is not to do with the letter, but I had a bit of a research there.
But this is the beauty of letters, mate. It sets you off on a path.
The MSCI have an index that tracks reopening, expansion, and then the two others that come after that, boom and bust or whatever. Contraction and then recession, perhaps.
Yeah.
And it's showing that, we're well and truly into reopening and just about to move into this expansion stage. And you can see how investors use that as a way to reweight portfolios.
Right.
And that makes sense. A lot of investors are now saying, the reopening stocks, it's time to, cyclical this, cyclical that. That's not for us, though.
Why? Well, I mean, now that you've said it, why is it not for us?
Too much risk for me of overtrading, and my whole thing is just to ride all these things out and just keep putting money into the market. So I don't have enough time to be sitting down and thinking about what are my reopening stocks, what are my expansion stocks, what are my recession stocks. Do you?
No, but the reason that I'm one is the overtrading thing, and that a lot of this chat around rotate to cyclicals, rotate to defensive, rotate to growth now, whatever it is it's coming from brokers a lot of the time, and it's coming from people that have an incentive to get you trading. But more generally, quality shines through cycles, and like the best companies in the world over the long term are like cycle agnostic. They do well for decades.
Yeah. That was interesting. Up 22%. So the reopen is well and truly on.
Yeah, and on the flip side, Goldman's StayAtHome basket, which is a similar index tracking staying at home stocks, I guess the Pelotons and the Zooms of the world, was down 2.4%. So you can see that market expectations are really primed around vaccinations happening, the world opening up quickly, the US opening up quickly, and those companies to benefit, and for the stay-at-home stocks to not do as well. So, if that plays out, that plays out. If it doesn't, then some of these companies will be re-rated. But what I liked about this letter was there was, I think, there was more than 3 case studies, but three that we want to touch on here. 3 companies that two that in particular that we admire. One that we used to compete against in our old lives.
Yes.
And is an incredibly good company. Like knows what it is, knows what it's trying to execute, and executes it. So, do you want to talk us through Costco, being the retail whisperer that you are?
The retail whisperer. So, the Ensemble guys speak about Costco and I guess the perils of short-termism and overestimating what's going to happen in the short term and applying that to your investments. So Costco was down 17% between the 31st of December 2020 and the 8th of March 2021. And that was driven largely by sell-side analysts who saw Costco heading into some headwinds and facing a difficult year of comp sales, which in retail is really where you're comparing your sales this year to the same period last year. That you want to see growth in that area, obviously.
Yeah, but I don't even think it was that they were heading into headwinds. I think it was just because of the comps.
Well, that's what I mean, as in the analysts saw Costco heading into comp sale headwinds.
Yeah. Okay,
but not operational headwinds.
Yeah.
So, and it all comes down to expectations in markets and for analysts. So they presumed that Costco wouldn't be able to compare to last year's sale. The thing to consider here with that is that the underlying value of Costco didn't change. In fact, it only got better. During the pandemic, their membership base increased by over 7%, which actually equates to just shy of 4 million new members. And not only that was that their membership renewal rates were, upwards of 90%. So not only were they attracting new customers, their retention rate was incredible. And so there was really no reason to think that Costco was going to have any issue with comparing.
Yeah,
and performing.
You're speaking in the past tense, but this is something that's happening now.
We are.
Yeah, so Costco, the market sold Costco because they wouldn't be able to compare to last year's growth numbers and may even go backwards compared to last year's COVID numbers. But I'm just having a look at TIKR. Their revenue was up 9%, which for a big box retailer, that's very...
it's huge.
Very unusual. Their EBITDA was up 23%. So they just had a cracking year last year and they may not be able to match that. But nothing's changed about the company. Nothing's less valuable, but the market sold them off 17%.
Yeah.
And for us, that's just a great example of where how the market looks at things and how you as a retail investor with a long-term perspective look at things can be different and how that can give you an advantage. Yeah.
All right. So they spoke about Charles Schwab. Do you want to give us a spiel of what happened there?
Yeah. Well, if the Costco story is a story about short-term thinking in markets, I guess the Charles Schwab story is a story about the benefits of long-term thinking. So Charles Schwab are one of those big US not multinational, but like multifaceted financial institutions, I guess. They have a wealth management division, they have a bunch of different financial services, and then they also have a trading platform. And they have been incredibly disrupted by Robinhood, but Schwab made the decision to basically just cut fees in brokerage, spread that loss out across their business, and really try and compete with Robinhood. And the market has punished them for it over the years. But quietly working away in the background, despite a lot of market commentary about how Robinhood's beating them, all this stuff, they've used the fact that they cut their fees to just massively grow their assets under management. They now have $6.9 trillion. Well, not all under management, but like assets in their business. And now as bond yields have started to increase, as there's talk of interest rates going up, the market, like all of a sudden it clicked, and Schwab was up over 23% in the quarter. And this fund Ensemble held them for a while, and could sort of see that story playing out, and it did. But it's just a story of how, again, financial media and the markets have one perspective, but then, attitudes changed, and, the Schwab story is a story now where, it's playing out.
Yeah. So to close out, Ren, another retail stock. I'm kind of annoyed about this because I did want to pitch this for the portfolio, but
You can.
there's going to be enough in here that we can just kind of add it on. But anyway, it's Home Depot.
Yeah.
Depot. However you want to pronounce it.
Look, pronunciation is definitely not something that people come to this show for.
True.
I'm pretty sure I just screwed up Charles Schwab, however you pronounce it, a number of times. So I wouldn't worry too much.
Charles Schwab. So this is a great story. For those that are unaware, Home Depot is the largest home improvement retailer in the United States. Think Bunnings, but over in the US. And Ensemble take us through why they think it is in an incredibly good position to have a really good next sort of 10 years. They're currently facing some pretty good tailwinds, which are supporting housing investment and the DIY, do-it-yourself, what's the word? Renovator. Not me.
Definitely not you.
So the three that they mention, there are a lot of millennials now who are getting into the housing market, but also starting to get a bit of money and some inheritance and that transfer of wealth from their parents.
Millennials are entering prime family formation age, I think is the way.
And good salary levels.
Well, yeah. It's like
about.
Buy a house, settle down, have kids, and you're right in that sweet spot, actually.
Obviously, very low interest rate environment, and over in America, we're seeing huge fiscal stimulus from the government as well, pumping $1.9 trillion in, with potentially a lot more to come. So, a lot of tailwinds that are supporting Home Depot when it comes to housing and DIY. But the company itself, Ren, pretty amazing. It has returned 17% per year for the last 15 years.
It's incredible.
Wow.
Yeah.
We love a company that is able to give great return on invested capital and compound over a long period of time. We speak about that, and this company is certainly one of them. They have had a return on invested capital of 45%, which, again, pretty phenomenal.
If you just invested in Home Depot and Bunnings, West Farmers, you would have done incredibly well for yourself.
You would have, yeah. So they go through a little bit about the business and where they're generating these sorts of returns. There are two sides to the company. There's that DIY side, which is the majority of their customers. But interestingly, there's another side, market that they're servicing. And you think about what happens here at Bunnings, it's very similar, and it's that small contractor market. It's tradies who don't have the buying power to go straight to suppliers. However, they go to Home Depot to get all the equipment they need for the small jobs that they're doing. These customers only make up 4% of their market, their customer base, but generate 45% of revenue. So, it's a pretty interesting split there.
I mean, it's pretty crazy. The flip side of that, if I was a competitor for Home Depot, I'd be like, you guys have all the retail mums and dads DIY. I'm just going to target that 4% of your customer base that makes up half your revenue. And if I can peel off even a percentage of them, that's going to have an outsized impact on you.
It's funny you say that. These guys, Ensemble, went out and spoke to a bunch of these small contractors, and verbatim from them was that they have one of the big competitors for Home Depot is Lowe's, and they, these contractors have said they would drive past a Lowe's to get to a Home Depot.
Yeah, but they didn't say they wouldn't drive past an Alex discount furniture mart. I mean,
furniture. They definitely drive past that.
Discount builders mart. No, I mean, for me, it's more like do Lowe's and Home Depot's suppliers just cut out the retail step and just try and supply to contractors and stuff directly. I'm not saying it's a thing that can
Yeah.
happen, but I'm saying that it's obviously the most valuable part of their business.
Yeah. They also talk about the fact that Home Depot have a very strong online capability, which we know is incredibly important. You'd think that would bring in the threat of Amazon, but due to the nature of DIY products and building products, there's a lot that is ordered online and picked up in store, which is something that Amazon aren't able to really do. So Ensemble don't see Amazon as a threat. But look, pretty interesting business and one that they see as benefiting from some huge tailwinds that over the next 10 years they think is, I think they finished the last line saying it's a promising decade ahead.
Yeah, now that's the interesting thing, because Home Depot, we keep screwing up the pronunciation of this name. Home Depot started it was like a micro cap that not a lot of people were covering, and you said what, 17% a year, average 17% a year over the last 15 years. So I had a look at Simply Wall Street, which has it 35% overvalued, and it's got an aggregation of a whole bunch of analyst estimates. It's a very heavily covered stock. 29 analysts have put projections on the line for the next couple of years. 6.1% is the forecast annual earnings growth for the next 3 years. So obviously, as it sort of matures and gets to that scale, you just can't expect that growth rate to continue. But I think it becomes a story of managing costs and finding strategic opportunities for growth. So
yeah, and these guys talk about that in that they're getting a lot of growth from within. They're not building a whole bunch of new stores. They're investing in existing stores, investing in technology, investing in their supply chain. And for a company that's giving a return on invested capital of 45%, I mean, you'd take that.
You would definitely take that. Yeah. And I think that's the same in the story of Bunnings. Bunnings continues to find ways to just become a more valuable company without having to open up heaps more stores, or I mean, it did try to go to the UK.
Yeah, and failed miserably. Well, that brings us to the end of our investor letter conversation, but stick around because we are just about to have a new segment called Crypto Corner. We know there's a lot going on in the space at the moment. We're not going to talk price as usual. We're not going to talk speculation. We want to be unpacking a bit more about what's actually going on in the blockchain space, and we're going to be bringing in some experts to help us do that. It's just a 5-minute segment, so
we did the week. We're not going to do a full episode on it. We're not that into it, but we are curious.
Yes, we're crypto curious,
and we are fascinated to hear about it. So rather than us talking about it, we've got Tracy, who's going to talk to us about the Coinbase IPO and what that means. Yes,
so this is Crypto Corner, brought to you by Bamboo, a micro-investing app that allows you to invest in precious metals, gold and silver, as well as digital assets like Bitcoin and Ethereum. Go to their app and use the code EQUITYMATES to receive $15 of Bitcoin when you sign up. But let's give Tracy a call to, as Ren said, hear about the Coinbase IPO.
So we're now joined by Tracy from Bamboo. Tracy, thanks for joining us.
No problem. Happy to be here.
Now, Tracy, we've seen a big story come out of the US around Coinbase. So they recently went public. Can you explain to us, I guess, what happened and maybe the significance of their IPO?
Yeah, look, and this has been described as a watershed moment for the crypto industry. Crypto has arrived mainstream. So, yeah, Coinbase, they've gained notoriety in the last few weeks as they're the biggest crypto platform and exchange in the US. So they have gone public on the NASDAQ, and that has been some pretty big news. So they are a crypto exchange, but they are centralized. And I think the point here to make is that in crypto, we're very focused on decentralization. So we look towards what you'd call a DEX. So a Coinbase is a centralized exchange, and a lot of us crypto nerds look to use a DEX, which is a decentralized exchange.
So what we'll cover in the next 5 minutes is really what is a DEX, DEX, or a decentralized exchange that a lot of us non-crypto nerds are hearing about, how it differs from traditional exchanges such as Coinbase, and then what are perhaps some popular DEX exchanges. So what is a DEX, Tracy?
As I mentioned, and as you pointed out there, DEX is a decentralized exchange. So this kind of decentralized exchange removes that third party and allows users to send cryptocurrencies directly to each other. So this market's built directly onto the blockchain, and that way traders can independently manage their funds, including the storage and the operation. So it's important to note here that it's managed by not a centralised exchange. So there's no longer need for that middleman, I guess, as you'd say. And most of these decentralised exchanges are built on Ethereum. So going back to a centralised exchange, it's worth noting that these exchanges are managed by a company or a private person kind of focused on generating profit for the company. So, you know, in that essence, I guess you're receiving a lot of fees, and these can vary wildly from platform to platform. So they have got complete control. A centralised exchange has complete control of this operation. So they also keep your coins there. So a DEX is, you know, completely independent from that. And if I'll just jump into a couple of the pros for these DEX, is security over your assets. Because it's decentralised, the exchanges don't hold your assets. You're kind of moving those yourself. There's also no need for personal identification for the accounts here. So you don't need to worry about someone kind of stealing your information, and there's no KYC involved. Another point is centralised exchanges can, you know, charge higher fees. On the DEX, you've kind of got lower fees there. So there's no centralised hub.
So, Tracy, I got to ask, how, like, I'm just trying to think of the analogy to stocks where, you know, brokers take your buy or sell order to the market, and then they, you know, the market matches it with a buy or sell order. If it's just Bryce and I trading crypto on a Ethereum-based decentralized exchange, like how are buy and sell orders, like how does the market actually function without any middlemen?
Yeah, it's quite similar. And I think we kind of, depending on how far down the rabbit hole some of the listeners have been, but they would have heard of, I'm sure, Uniswap, SushiSwap, Kyber, those bigger ones, Pancake, which kind of sounds silly as I'm saying them out loud. But these are, I mean, Uniswap's massive. Uniswap is the biggest and kind of the first one that forged that path along. So you, just to explain what I would do then, so you jump onto one of these exchanges, you would then connect your wallet or I have MetaMask, for example, so you connect your wallet, and whatever you've got on there, it's a very easy interface. You pick the coin that you want to swap with the other coin, and you move those around that way. So it's really easy, and I think the user experience on all of these is very different to your traditional exchanges. It's kind of, for lack of a better word, just dumbed down a little bit, and they're a lot easier to use.
Why do you think that if the benefits are there compared to a traditional exchange, particularly for those who are, I guess, nerding out a bit on crypto, why are these not as big as the centralized exchanges that we're seeing?
Well, the centralised exchanges, I guess, you can trade. I mean, you can trade on those, and they are, well, traditional in the fact that bigger, more liquidity, I guess, those ones. These ones, liquidity is a big drawback for the DEX. And then, I think liquidity would probably be the biggest one there.
Yeah, fair.
So you mentioned there that centralized exchanges have a profit motive, and they obviously do. The Coinbase founder is now a billionaire, so full credit. But
he's done very well for himself.
But there are, there are a number of DEXs, but surely they're not set up as not-for-profits or charities. Like these companies must have a profit motive as well. So, or unless I'm wrong, then please tell me. But I guess how do they make money?
Yeah, absolutely. And look, I think something I heard the other day, Uniswap, which I mentioned, I mean, their annual business hit 6.5 billion and they've got 12 staff.
Wow.
So,
Wow.
Wow.
yeah, that's pretty amazing. And I think that's why if you looked at, this world of DEXs 12, 18 months ago, there's maybe 3 and there's literally hundreds now. There's so many. So it's lucrative business. Otherwise they wouldn't be popping up like they are. And I think a lot of them too, they put onus back on the community. I think that's why they are loved. A lot of it goes back into market. A lot of it goes back into keeping fees lower and transaction fees lower. So it really it plays into that whole ethos of why cryptocurrency and Bitcoin is around.
Mm. Now, Tracy, we really appreciate your time. It's definitely something that I hadn't heard of before. I'm not sure if you had, Bryce.
No.
DEXs. Final question for you. Right now we're talking about DEXs in the crypto space. Should we expect to see a conversation about DEXs in like other assets, like in the share market?
Not in the near term. I wouldn't think so. I mean, look, this has all come along because of the huge interest in this DeFi sector and how it's grown so quickly, but I wouldn't see that happening in the near term.
Yeah, fair. Well, Tracy, we do appreciate your time. The first crypto corner on Equity Mates. If you would be so willing as to come back on in a couple of weeks, we would very much appreciate that to give us another update on what is going on in the crypto space, because there's certainly a lot to keep up with, and Ren and I are by no means an expert in, or don't even keep up with it.
Yeah, that's why we've got you, Tracy.
No, not at all. I'm looking forward to it. I mean, look, there's so many things to cover. Who knows what I'll do in 5 minutes next time. But it'll be something interesting, that's for sure.
But until then, if you are interested in getting started on your own crypto journey, head to getbamboo.io or download the Bamboo app.
Yep.
It's a micro investing app for crypto and precious metals. And if you enter the code EQUITYMATES, Bamboo will send you $15 in the asset of your choice: Bitcoin, Ethereum, gold, or silver.
Yeah, nice. Well, thank you, Tracy. Have a great
Thanks,
day,
guys.
and we'll catch up in a couple of weeks. Well, Ren, that brings us to the end of the episode. As always, it is fun to chat stocks and a tiny, tiny, tiny bit of crypto.
That's just like life. 99% stocks, 1% crypto.
That's it. So we'll pick it up next week, as always. But until then, I'll probably see you in a couple of minutes.
We're sitting together. Keep it in.
Keep it in.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.